Hi everyone, today in this video I want to explain you how to beat the stock market using machine learning. I will explain you in this video how the algorithm works. I will guide you step by step. You don't need any understanding of programming, machine learning, finance, everything will be explained in this video. And at the end of the day you will be more profitable with your investment. And let's get started now. So the first step is actually to get the data. That's the most boring step, but it's something necessary because if we don't do that, we cannot get started. So to get the data back in the day, it was actually possible to get them from Yahoo Finance API. It was also possible to get it from Google Finance API, but because companies actually sell this kind of information, Yahoo and Google, they cannot provide them through an API. So to get some data, what we will do is to use Wikipedia, because in Wikipedia you have the list of all the companies in one index. So for instance, if you want to look into the S&P 500, you have all the list of the companies.
And then we can actually one by one, but of course doing this automatically, use the symbol here. So we have 3M. If we either put it here in the URL, or if we actually input here 3M, then we find this company. So we will have all the summary here, all the information about the stock, what is the current price earning ratio, all these kind of multiples that we will explain later. Then we have the historical data with the share price for every day that it was traded. So for instance, between the 1st May and the 4th May it was weekend, so that's why there is no data. Then we have the statistics, where we have the profit margin, operating margin. So we have here the different multiples. So for instance, the profitability, how well the business is performing, what is the profit margin, what is the operating margin, all these kind of multiples to compare businesses and see which one is performing better. We have, for instance, return on asset, return on equity.
Now that we have all the financial data that we need to select them, because it's too much information. We cannot make sense out of it if we don't understand the data. So now what we want to do is to understand which kind of data we need for our model. How we do that? We get inspired by what an analyst would do. How an analyst can actually value a business? That's a really easy question to answer. They use multiples. If they want to compare one company versus another one, they need actually to have some similar numbers.
Let's look at the first type of multiple, which is the price. So we have different multiples about price, like price earning ratio, which is the most famous one, but there is also price to book ratio or any kind of other multiples about price. It can make sense to have multiples about price. So for instance, Warren Buffett is really keen on buying some stocks that are not too expensive, and price earning ratio, for instance, is a good indicator of if the stock price is expensive or not, because it compares how much the company earns with what is the price of the stock for this company. But it can also be that the price earning ratio is low because the company is not doing great. It can be that the price is actually justified. It can be that the company is about to be bankrupt, and that's why the price earning ratio is low. The second multiple that we are going to see together is about enterprise value. So if you don't know what is enterprise value, just wait a bit, because I'm going to talk about this more in detail and explain exactly what it is. So there are different multiples about enterprise value, like enterprise value to free cash flow and so on. Then the third kind of multiples that we are going to see is any multiples about business efficiency. So for instance, profitability, what is the gross margin, what is the profit margin, operating margin, all this kind of KPI or multiples that can help us to see how efficient is the business, how they use their resources, how efficient are they in their management. Then last but not least, we have a lot of multiples that I would say other multiples. So for instance, the leverage of the company, how much debt and how much equity the company has, what is also the tax that the company pays, how much dividend are they paying back to shareholders, and so on. Let's see together the enterprise value. The enterprise value is defined as a debt as it's priced by the market, plus the market cap, so any kind of equity and how the market value this equity, minus the cash that the business has. Why does it make sense? Because when you are using your own cash to invest in the business, then you don't want to invest in a business who has a lot of cash. You don't want to buy cash with cash because it will bring you the same return investment. Let's understand now what is market return, because at the end of the day we need to evaluate what we are doing. So we need KPI to understand the profitability of an investment. When we buy a share for $10, it can be that the share price increase. In this case, let's say if we can sell this share for $12, then we will have 20% market return or 20% profitability. But it can also be that the company pay out some dividends and the share price doesn't change at all. It can be that the share is still traded for $10, and in this case then we'll still have 20% profitability because we will have a share of $10 plus $2 of dividend. So at the end of the day, market return is just a combination of the price increase and also the dividend that the company pays.
Now it's getting interesting. Now that we have all the data and we crunch some finance, then we can use AI to predict the market return. Let's get started.
Let's see together the first algorithm that we have in terms of machine learning. We have decision tree and random forest. Random forest is actually a specific variant of the decision tree, which is more systematic in the way that it tackles a problem. So the random forest will be actually slower than the decision tree, but in most of the cases, let's say it will be more accurate because it will be more systematic. So how the decision tree works. It looks at every kind of multiples that we have from the really beginning. So for instance, the price earning ratio, and then see if there is one threshold that split the data in two groups that have different characteristics. So the characteristic that we are looking into is the return that we defined before. So whenever we have in this example a price earning ratio which is above $15, then we will have higher return. And then we have the tax rate. So let's say if the tax rate is low, then the return will be higher. So actually here it should be smaller than 25%, for instance, then the return will be higher. And then if the tax rate is below this threshold, then the return will be lower. On the other side of the tree, so still starting from price earning ratio, if we are below this threshold of $15, then we will have another kind of multiples that will be evaluated by the decision tree. So for instance, let's say the decision tree say that earning per share will be a good multiples or a good feature to estimate the return. This will be used by the decision tree, and then it will be splitting again the data that we have. So for instance, if we have earning per share which is above $5, then we have high return, and then if it's below, then we will have low return. So the next model that we are going to see together is the k nearest neighbor. For instance, if we don't have any information about this data set, or if we want to predict what is the market return for this data set here, the way the k-nearest neighbor works is that it will use the nearest neighbor that it can find. So for instance, if we have another group of data here, another group here, another group here, then it will check which one is the nearest one. So maybe it would be this one, maybe it would be this one. It seems a bit less likely that this one, but it will actually see which is the nearest one, and assume that it has the same outcome. So for instance, assume that it has the same market return. It's exactly the same as assuming that if you want to know what is the income of someone, then you go from door to door to ask the neighbors how much they earn, and then assume that it's someone earned the same. So that's why it's called actually K nearest neighbor. Finally, the last model that we are going to see is neuronal network. So from my experience, neuronal network, they don't really work well for anything about pure data. They became much more trendy recently because of deep learning, but this is more used in terms of image analysis, or also if you want to analyze some text. So the neuronal network work with different layers of neuron. The first one is the input layer. So for instance, the price earning per share. So all those multiples that we already mentioned before. Then we have a hidden layer, and then we will have the last layer, which would be the market return, so the outcome of what we are going to do. So theoretically, it makes sense to use neuronal network, because it can be that there is in any sort of way a combination of multiples. So for instance, the first one 1 time plus, let's say, 0.7, then maybe minus 0.3 or whatever. So any kind of combination, and then this would be let's say divided by 4. Any kind of combination of multiples that will actually give us, at the end of the day, the expected market return that we are looking for.
So we got our models. It took us quite a lot of time to build our models. It was really difficult, but right now we did it, and now is the most interesting time. Which is the model that works the best? And maybe it can be that none of them work. Let's check it out. So we got our model. We know actually quite a lot of things, but at the end of the day, if our model is not performing better than being just random, then there is no point of it. So how do we estimate if it's working well or not? We actually use what we call X square. I mean that X square is actually how well the model is predicting the return on investment. We take one index, let's say we take the S&P 500, to train our model, so to understand how finance works, and then we take another index, let's say FTSE 100, and if just based on the multiples, it can actually predict well the FTSE 100, then it's good. If it's worse than random, then we just did everything for nothing. So we can actually draw a straight line from 0 to 1, from -1 to 1, sorry. 0 being the same as being random. So if we just pick up any stock randomly, or if we just invest in the market with buying all the shares, then we will have the same return. How well does it perform? We have the linear regression. So those models and the SVM are actually performing poorly. They bring an estimate of -2%. Sometimes if we tweak them a bit, we can get a 5%, but it's not really so significant. We have also the K-neighbor. The K-neighbor is not doing so bad. Actually, even without tweaking it, we get 5% accuracy, and we got also the neural network, which is doing really terribly. So I don't advise anything with neuronal network. Neuronal network is for stock prediction is doing really terribly. We get minus 28% of x square. But if we tweak it, we can actually bring it back to 7% of x square. But the good news is that the decision tree and the random forest are actually doing really well, and we actually get, because they are really similar algorithm, we get the same prediction, and this is an x square of 23%. So it actually means that if the market is giving us a return of 10% every year, then if we actually use this model to predict in which stock we need to invest, we will get a much better return. We will get a return of 12.3%. So it's actually, if you think about it, based on the compound interest, if we invest every year and we can increase the return on investment by 2% on a yearly basis, that's just amazing. So I hope you are really excited about that. I'm going to share a lot of insight about the decision tree and the random forest in another video. Let's take a step back. So we use the information of Yahoo Finance and any kind of financial information that we got. But there is something important that we need to say here, is that a lot of companies are actually using the financial statement because they know how investors think. So what they want to do is to trick investors by hiding some numbers, hiding what they actually do in the footnote of the financial statements. So it's really important to read the financial statements carefully before investing in the business, because if we just take the raw numbers, it can be misleading. It can be that companies use the numbers and hide some information in the footnotes or wherever. So I will share with you how to check a financial statement before you invest in any business. I hope you liked this video. I really enjoyed it, and I hope you enjoyed it too. Give me a like if you like this video. Let me know if you have any question, if you want me to cover any topic in the future. I'm happy to do that. I will be posting some videos on a weekly basis to keep you informed, to keep you updated. Make sure you subscribe to my channel so that you don't miss any tips about investment. Stay tuned and be safe.